This is Franz. Welcome back to the SIE podcast, the Securities Industry's Essentials Exam podcast. This is going to be the fourth sample lesson of the 5 sample lessons that I offer in this podcast for you to evaluate to determine if the full series of audio lessons make sense for you. In this lesson, we're going to be covering special securities, which include warrants, rights, and American depository receipts. After listening to this lesson, if you think the full series of audio lessons makes sense for you, go to the website siepodcast.com and download the full series of audio lessons. Let's get on to today's sample lesson. Welcome to the Securities Industry Essentials Examination podcast, audio lessons for the SIE exam. This is lesson number 4, special securities, which include warrants, rights, and ADRs. And in the outline, this is going to be covering section 2.1.1. First of all, warrants. Warrants are basically rights to purchase stock at specific prices that are long-term in nature. These differ from rights, which tend to be short-term in nature. A warrant may be issued by a company simply to raise money by selling the right to buy the common stock at a certain price. It doesn't appear on the balance sheet as an equity. It is simply a warrant. Now, in calculating the earnings per share fully diluted, they will take warrants into effect. But for the most part, it's sort of like free money to a corporation that issues warrants. If you issue warrants and you sell these warrants to the public, you get a certain dollar amount for the warrant. Now, if at some point in time the stock underlying that warrant rises to a certain point to make that warrant valuable and people convert into stock, then the company gets the additional equity from the purchase of the stock. So warrants are used as basically an enticement to people to start watching a stock. And basically a warrant is a long-term option to buy the stock at a specific price. Warrants quite often are attached to the sale of stock as a kicker or teaser, or a sale of a bond, or a sale of a preferred stock. It can be attached pretty much to anything. But when they do that, it's called a unit. And you might, for instance, get one common share and one warrant to buy a common share at the price of the common stock plus, let's say, $1 or $2. So for instance, let's say a company issued some stock at $30 a share. They might attach to that stock issue a warrant or a right to buy an additional share of stock at $35 per share. So that would be what is called the unit. So the people would buy the stock, and warrants can be traded on their own. And you will see listings for warrants in the financial listings of securities, of negotiable securities in the financial pages. Now, when a warrant is issued with another equity or another bond or another preferred stock, there's usually a wait period before they can exercise this warrant. And the wait period can be determined by the company when they issue the unit. Usually it's sort of like a year. It could be a year. It could be 6 months. It could be more than that. Now, warrants most often have an expiration date, and usually it's about 5 years out. But there are some warrants that are perpetual warrants and will trade forever. And the warrant will have value based on the underlying stock that it's tied to. Companies will often issue warrants because it adds sort of a kicker to the value of the stock. It tends to increase the ability to issue a secondary offering at a slightly higher price than they might be able to without that, the warrant as a enticement to buy that common stock. When warrants are issued, it's usually issued the purchase price, the option price of the warrant, is usually a substantial premium over the issued price of the stock. In the example I gave, the stock would have to go from $30 to $35 for that warrant to have any intrinsic value. So that should be something you understand, that premium is usually significant. Now, rights are another type of a enticement to buy a stock. And we talked about rights when we talked about common stocks. And rights usually come about as a result of preemptive rights in the company's charter. So a right is issued to an existing stockholder, usually because that stockholder has a preemptive right to buy a new stock issue by the corporation to maintain his proportionate ownership in the company. And rights also trade separately and will be traded on the exchange while they're in existence. And rights are usually fairly short-term in nature. The last thing we're going to talk about in this episode are American depository receipts. And American depository receipts are simply the vehicle for trading foreign stocks on the U.S. markets. A good example of this would be, let's say, Anglo-American Corporation. Anglo-American Corporation is a South African company, but its stock trades on U.S. exchanges as an American depository receipt. Now, the reason companies do this is they want to have the liquidity of the U.S. stock market, but they don't want to be registered in the United States because they don't want to have to follow the Securities and Exchange Commission reporting rules. It's time-consuming and usually quite expensive. So instead of being fully listed as an American listed securities, they will list the American depository receipts. And American depository receipts can represent one share, fractional shares, or multiple shares of the foreign company which it represents. Now, an American depository comes about usually as a result of banking relationships with a money center bank. For example, a money center bank in another foreign country, let's say somebody like Citicorp, which has an office in, let's say, to keep it simple, South Africa, would buy up a large block of, let's say, Anglo-American stock. This is just being used as an example. And then the bank issues American depository receipts, which are backed by the securities that they hold in a trust. When dividends come through, they are passed through to the holders of the American depository receipts. One big difference between American depository receipts and common stock is that American depository receipts do not have voting rights, and they do not have preemptive rights. American depository receipts are registered with the Securities and Exchange Commission in order to be sold on the U.S. markets, but they're registered as ADRs and not as corporations. Sponsored ADR, an ADR just means American Depository Receipt, use only one depository bank, and that's appointed by the issuer of the stock. Issuers that sponsor ADRs must provide annual reports and quarterly reports in English to the holders of the ADR. Now, there's another type of ADR, which are non-sponsored ADRs. And non-sponsored ADRs are assembled by banks and brokers without a issuer participation. In other words, the underlying corporation is not working with the bank or the brokers in order to create this American Depository Receipt. And this differs significantly from sponsored ADRs, primarily in the fact that the annual reports are not required to be produced in English for U.S. non-sponsored ADRs. There is quite a few ADRs listed on the U.S. exchanges, and that list has been growing significantly over the years as exchanges try to get more and more international business. Now, the ADR prices are influenced primarily by the stock values of the underlying corporation. And one other thing that is important to understand, that ADRs pay dividends in the currency of the country where the corporation of the ADRs are located. So in the case of Anglo-American Corporation, it would be in the South African rand. But that converts into the U.S. currency, and you're paid your dividend in U.S. currency after the conversion is done. So you run a currency risk as well as a market risk in ADRs. Dividends that are distributed on ADRs can have taxes withheld by the foreign company, the company of origin, but you as a holder of the ADR can claim that tax withheld as a credit when you pay your U.S. taxes. So that's going to finish up this episode. And let's review what you need to understand. What is a warrant and how does it differ from a right? How do warrants come about? How long can the life of a warrant be? What are rights? How do rights come about? And you may need to return back to the common stock episode and review rights in that, because we covered rights very briefly in this podcast. And finally, what are ADRs? How are they created? What's a sponsored ADR and a non-sponsored ADR? How are dividends paid? What risks are there in an ADR? And how are taxes handled, foreign taxes handled with ADRs? Before we leave the equity section, we need to talk a little bit about how you find information on companies you're looking at on the internet. Now, if you're already at this point, you probably know how to do it, but let's just go through a few sources of information. And the one a lot of books talk about is called the Standard & Poor's Net Advantage, but that's a paid service. And in fact, in all my years of business, I've never subscribed to that service, but that's one that you may talk about. And that's also one where a lot of other free services get their information from. Now, what information is contained in the Standard & Poor's Net Advantage? Well, the ticker symbol of the stock, the par value of the stock, the shares held by institutions, the type of business it is and a summary of the business, the range of the stock for the last 16 years, stock sales or volume for that month, the high prices, the low prices, the closing prices for the month, if there's been any recent stock splits, the dividend paid, and the ex-dividend date and the date of record for past dividends, and the dollar amount of dividends as well. The earnings per share for the company for the last 5 years, the financial position of the company, it may have a quick balance sheet, and a lot of other information. But speaking personally, the place I usually go to for stock information as a starting point is just Yahoo Finance. It provides almost all of that information as well as interactive charts and also a price lookup database for historical prices on stocks. Also, Google has information on individual companies. And if you want to go to the mother of all information for background financial information on the company and company reports, you can also go to Edgar Database, which is the Securities and Exchange Repository for all filings which are made by the company. In addition, if you're looking for a little bit of insight into institutions that are buying and selling the company's stock, and this would be like the hedge funds, well, not necessarily the hedge funds, but any reporting entity that has to report its trades, for instance, mutual funds and some money managers, you can go to a firm called Whale Wisdom. It's not a firm, it's a website called Whale Wisdom, and you can put into that website the stock symbol of the company you're looking at, and you can find the institutions that own that stock. And then you can also look up specific institutions and see what their recent purchases. These reports are filed quarterly, so they could be trailing as much as maybe 3 or 4 months. But that's where I typically go for information when I'm looking for specific information on stocks. My starting point is usually Yahoo Finance, but you also might choose MSN Money or some of the other services, whatever you get used to. But that's where you go to get some of the information on stocks. And you'll also be able to find information on warrants and rights and preferred stocks. Preferred stocks are a little harder. I find a different database for getting information on preferred stocks, and if you just Google preferred stock database, you're going to come across it. I can't remember what it is right off the top of my head, but it's a link that I have set up on my computer. So that's information on where you're going to go to get information on stock. It's a lot easier now than it was when I started in the business. When I started in the business, you used to have these little old tear sheets and books called Standard & Poor's tear sheets. And there was a one-page summary of the companies. And you go to your broker's office, and this is back in about the 1970s I'm talking about. And you go to your broker's office and you'd copy them off, and it would give you a 2-page summary of the company. And that was about it. And then if you wanted more information, you had to actually write a letter, a real letter, because email didn't exist back then, to the company and ask for their annual report. And then you'd get that in the mail. This is going to finish up this lesson on special securities and pretty much finish up the equity section that you need to understand for the Series 7 examination. Thank you for listening to the fourth sample lesson of the Securities Industries Essentials Exam podcast audio lessons for the SIE exam. Now you've started to scratch the surface of the full 36-hour and 53-minute series of audio lessons I have prepared for the Securities Industries Essentials exam. If this audio style of learning is working for you, go to the website and click on Purchase the Full Series of Audio Lessons. Best of luck. Keep studying.